Welcome to Accounting with Our Bare Hands, a series of short videos on the mechanics of cost accounting. This is our final video on standard costing, fixed overhead variances. Now, fixed overhead variances mechanically are very simple, but they are confusing, so you'll want to pay close attention. We will be continuing with our example of an essay grading service. Our service budgeted to grade 100,000 pages, and we thought that our fixed overhead would total $25,000. Instead, we graded 110,000 pages, and our fixed overhead was $30,000. Now, when we think about what caused our fixed overhead to be too high and too low, well, we looked before in an earlier video on variable costs. You will recall that, so here were our labor costs, and we used an example of a rectangle. And we said, so our labor costs, we expected, given our 110,000 pages that we graded, we thought that should take 55,000 hours at $20 an hour. And so we had a rectangle here that indicates the size of our costs. And it actually cost, it actually took us 60,000 hours at $22. So we had a bigger rectangle representing our actual costs. This is a very useful analysis for variable costs because it makes sense to think of variable costs as being the product of price times quantity. But it does not make sense to think of fixed costs as the product of price times quantity because, in fact, they are just lump sums, right? We didn't spend $30,000 on fixed costs, $5,000 more than we thought, because we did more work, because by definition of fixed overhead, the amount that we're going to pay is independent of the amount of work that we do. So a rectangular decomposition isn't going to work for us. Instead, we're actually going to use a linear decomposition. We're going to say, here's the amount that we incurred, and here's the amount that we applied. And so the difference between these in normal costing, we would simply lump this, we'd just view this as one difference over, or in this case, under applied overhead of 5,000. Okay, or whatever, actually we'll get to the number, it isn't exactly 5,000. And then what we're going to have to do is split this into two parts. Now, what are the two causes for us to incur more or less fixed overhead? Instead of trying to do that price times quantity decomposition, we are simply going to compare the amount that we incur to the budget and the amount that we apply to the budget. Now, the difference between the amount that we incur and how much we budgeted, right? So in this case, right, that's going to be $5,000 actual minus budgeted. Well, that really just means that our bills came in too high. We thought rent would be some amount a month. It was a little higher. Our insurance, our taxes got raised. We paid a little bit more to, we gave a raise to our engineer who works at the plant, who's viewed as a fixed cost. Any of these things might happen that would increase the amount that we incur above what we budgeted. What accounts for the difference between how much we applied and how much we budgeted? Well, remember that the amount, every time we grade another page in our essay grading service, we're going to apply a little more cost. And so if the applied amount is less than the budget, that means that we did less work than we budgeted. Okay, so let's take a look and do the math and see how this all plays out. Again, as before, we will draw out our variance crown. The top left is the amount that we incurred. The top right is the amount that we applied. Okay? So let's look at how much we incurred. Boy, that's easy, right? We can just read that off this table. We incurred $30,000. And we're not going to try to think of that as price times quantity, because this is a fixed cost. There's no quantity that we really need to think of here. The applied amount does, however, vary with quantity. Remember how absorption costing systems work. Every time we make a unit, we're going to apply a little more fixed cost. How much more fixed cost? Well, we projected in our budget that we'd have $25,000 of fixed overhead, and that was going to be spread over 50,000 direct labor hours, so that's 1/2 of a dollar, 50 cents per direct labor hour. That's our predetermined fixed overhead rate. So we're going to take our 110,000 pages. We're going to then multiply that by the half an hour that each page should take, and we're going to multiply that by the 50 cents per hour that we should have in fixed overhead. So that's a quarter of $110,000, or $27,500. So you can see right off the bat that we have $2,500 of underapplied overhead. We only applied $2,750. We incurred $30,000. In the old days, under normal costing, we would have just taken that, made a single adjustment to cost of goods sold to reflect that. But we are now going to consider our split point, where we split this according to the budget. Now, what did we budget? Looking back here, we budgeted $25,000. And so now we have two causes for our variance. $5,000 of a cost overrun. That's going to be an unfavorable amount, okay? And that is because of our what's called the fixed overhead budget variance. Okay, so we've got a $5,000 unfavorable fixed overhead budget variance because we should have spent only 25, we spent 30. That's only because insurance or rent or something like that came in too high. This applied amount, well, here, right, we actually, after you consider this $5,000 cost overrun, now we have a little component of overapplied overhead, because we applied $27,500 when we only budgeted $25,000. So we are going to have $2,500 here of a fixed overhead volume variance, and that's because it's a volume variance because the only reason that we applied more than we budgeted is because we graded 110,000 pages instead of 100. It's pretty easy to see, if you want to think about this, right? We can write the applied amount as being the standard quantity of the driver per units produced times our standard price, the predetermined fixed overhead rate. Well, this $25,000, if you want to think about it exactly that way, that's just the $100,000 that we originally budgeted times the standard price. So this is really the budgeted quantity times standard price. The only difference between these two numbers is that we did more business volume than we anticipated. So this is a volume variance. Now, You'll notice I've hesitated to put an F by this. I'm going to put it in parentheses and a question mark. First, why do I have the F there? Because this looks and smells and acts just like a favorable variance. We over-applied overhead, and so when we make our adjusting entry, we are going to reduce cost of goods sold by $2,500. That's going to increase our income, just as if we had somehow saved money. But the question mark is there because it's not necessarily a good thing that we did more work. If this, this was Ellie Goldratt's big point in the book, The Goal, where he excoriates cost accountants for encouraging managers to produce stuff they can't sell. So we wouldn't want, if this were a business that could build up a bunch of inventory, we wouldn't want to say, oh, that's great that you made a bunch of stuff more than we budgeted, even though we can't sell it. So people hesitate to call this a favorable variance. But to see why it acts like it, let's make our debits and credits. I'll be assuming that we are using cash to pay our fixed overhead costs. Okay, so we incurred $30,000. That's going to be a credit to cash. We're going to put it into manufacturing overhead. We apply $27,500, and that is going to go into work in process. And now, to make the entry balance, we are going to create two variances. We're going to create our fixed overhead budget variance, and that is going to be, that's unfavorable. That's going to be a $5,000 credit here and a $5,000 debit there, reducing income by increasing cost of goods sold. And then we have a $2,500 debit here and credit to our fixed overhead volume variance. Now our manufacturing overhead account has $32,500 on the left and right, so it's zeroed out. We have an adjustment that's going to increase cost of goods sold for $5,000 and reduce cost of goods sold for $2,500. So this is the last of 5 videos on standard costing, and the last 3 have allowed us to fill out our new, much more complete cost of goods sold statement. Our applied amounts at standard costs come up to our unadjusted cost of goods sold of $1,237,500. We have now 6 different variances. Okay, we'd have 8 if this example included direct materials, because there's the direct material purchase price and usage variance. And all those adjustments get us to a much higher adjusted cost of goods sold of $1,410,000. Again, the key lesson here is that for firms that care about isolating the responsibility for cost overruns and underruns, we now have a line in that adjusts cost of goods sold for many different reasons. Right here you see 6 different reasons that our costs may have been too high or too low. And they're on the income statement, so people are going to talk about it. We paid our workers too much per hour they worked. That's why we have an unfavorable direct labor rate variance. We have an unfavorable direct labor efficiency variance because they worked too many hours for the pages they graded. We have an unfavorable variable overhead efficiency variance for the same reason, because that labor time is our variable overhead driver. We spent too much on variable overhead because we used too much of the driver. We reduce our cost of goods sold because we were able to lower our rate per hour on variable overhead. We have an unfavorable budget variance. We spent $30,000 on fixed overhead when the budget said we should have spent $25,000. Darn those rent increases. And then finally, we have a little bit of a reduction in cost of goods sold because we applied too much, because we graded 110,000 pages instead of the 100,000 we thought. So we applied a little more than the 25,000 we projected. That's our variable overhead volume variance. If you are in a business that cares more about identifying efficiencies than about identifying the exact margin of each individual item, standard costing is a very useful system for you. If what you care about is the true margin on everything you produce, it's not going to work so well, because your unadjusted cost of goods sold, which is the only part that's split out on an item-by-item basis, is only reporting what it should have cost you under standard costing, not what it actually cost. So your margin is really just what your margin should have been, which isn't as useful if margins are important to you. But if efficiency is important for you, here's your system: standard costing. I hope you found these videos on standard costing useful, and stick around for more when we get to new topics. Bye-bye.